Hello everyone. So today we'll discuss about financial management and let's get introduced to the financial management in this module. Before starting, I would like to give an example. So imagine Mr. X is working with a company, right? So Mr. X will be, earning some salary, correct? That uh, that company pays him, say, some 50,000 rupees per month. Also, it's not like he'll not spend anything out of that 50,000, correct? Out of that 50,000, let's assume that for his day-to-day needs, he'll be spending some 40,000 rupees of money. It might be his electricity bill, or it might be his commutation expenses, or it might be his food, or anything for that matter, or the rent of the building in which he stays, or something like that, right? So, end of the month, he'll be left with rupees 10,000, correct? So this 10,000 when set aside without spending, we call it as savings. Like maybe he'll be keeping it in his cupboard or in his locker or somewhere. This money will be available to him when he needs. Correct? After say some 3 or 4 months, he would have accumulated some 30,000 or 40,000 rupees of money, and this money will be available for him at his fingertips. Whenever he wants, he can just take that money and use it for the purposes. While coming to the investments, it doesn't work that way. You know, he'll be employing this saved funds, right? When I say he's employing these funds, I mean that he would have purchased any securities like equity shares or debentures or mutual funds or given loan or anything like that, any of such sort, correct? For which he'll be earning returns, correct? Along with returns, there is one factor called a risk. Risk and return, we call it as, we can say that there are two sides of the same coin. If you want to expect returns, it is quite obvious that you need to take up risk. Risk can be of different ways or in different means, which we'll be discussing further in this module. But as of now, when I say that he has invested 10,000 rupees, first thing is that the returns which he expects from that 10,000 rupees. Suppose he, keeps it in the fixed deposit. A simple example: 10,000 rupees per month he'll be keeping it in his fixed deposit, for which the bank will be paying him, say, some 8% rate of interest. This 8% is subject to changes. As and when RBI changes its repo rate or reverse repo rate, it is quite obvious that the banks will also change its interest rates, correct? This 8% might become 7.5% or 8.5%. So this variability in returns is what we call it as a risk. That is one aspect of risk. Let's assume another example. This 10,000 rupees what he had saved, or the surplus 10,000 rupees, he gives out to his friend who was in need, and his friend had promised him to pay some amount of interest, maybe some, let's assume 15% of interest per annum. Unfortunately, maybe after 3 months, his friend was declared as insolvent. The entire capital goes off. He cannot recover the capital itself. So the parts of risk will, or the types of risk, we'll discuss later. But as of now, this let's understand the difference between savings and investments. Savings is simply setting aside of money without spending. Like maybe I want to buy a Puma t-shirt of 50, say 1500. I may defer my consumption. This month I was supposed to purchase, I had plans of purchasing the t-shirt. I'll just defer this by 1 month. So that 1,400 rupees lies in my pocket for this entire month. This is what we call it as savings. While coming to investment, this 1,500 rupees, when I make a fixed deposit for 30 days, that becomes my investment. It is like the sacrifice of current money or other resources for future benefits. So now let's understand what is meant by economic investment and financial investment. Before that, let me just tell you how actually the capital markets and other financial markets work. So basically, the traditional mindset of our country is that instead of investing elsewhere, investing in any other securities, it is safe to keep it in our pockets. Correct? Often we come across our parents keeping money in the small vessels or small dabbas at our kitchens. Correct? So why does this? I mean, what is the actual reason behind this mindset? They're very insecure about their capital going away or incurring losses. So they find it very safe to keep money with themselves. So what will happen then? If they keep accumulating money with themselves, the capital flow in the economy reduces. For example, uh, yeah, I'm an employee with my college, so my college is paying me some amount of salary. I'll be spending say some 80% of my salary, and 20% I'll be keeping it in my cupboard. So that 20% of my salary gets reduced from the capital flow. What I mean is that, let's consider this. If I invest 20% of my salary to a mutual fund, that mutual fund uh, you know uh, that uh, yeah, the fund manager, what he does is that he'll be having some 100 clients. From each of the client he'll be collecting say some 5000 rupees per month. So these accumulated funds needs to be invested in various other portfolios. So I hope you guys understand what is a portfolio. Diversification of the investment, we call it as portfolio. When he tries to invest, maybe he'll invest in stock market, he'll invest it under as a angel investor uh, for a startup, or he might invest in fixed deposit, he'll invest in gold, and it depends on fund to fund. So the savings which I had made, I'll give it to the mutual fund uh, manager. Mutual fund manager, what he does is that he'll give that money to the uh, startup for starting up their business. So then that uh, that startup or that person who starts up gives employment to various other people when he starts his business. So for those people, he'll be giving them salaries. So this is how the economy develops. So they'll be earning salary, and that salary earned will again be invested. Also, you need to understand that the services or the products produced, or there'll be more products and services coming into the market. This is one aspect. So this is how the entire economy of the nation will prosper. So now let's understand what is economic investment and what is financial investment. An individual savings flow into the capital market as financial investment. So whenever I invest my part of the salary to a mutual fund or a fixed deposit or any other vehicle, it becomes a financial investment. Those are again used as economic investment. Like as I said, they might give money to a startup. That startup person might purchase machinery or buildings or any other needs for, I mean, to meet the needs of his firm or startup. That is the reason we call economic investment and financial investment as interrelated terms. Now, coming to the key aspects of investment, there will be two things to an investment. One is time, and next is risk. Uh, So, yeah, imagine there are two options. One is that if you invest 100 rupees in plan A, it will give you 150 rupees. And if you invest in plan B, it will give you 200 rupees. Now, just by looking at this data, you might come to a conclusion that it is better to invest in plan B, which gives you 100% of returns. But the time frame also matters. Maybe the plan A might give you returns in 5 years, whereas plan B gives you returns in 15 years. So the time frame also differs. Instead of investing 100 rupees in plan B, you can invest 200 rupees in plan A so that you will be earning uh, 250 plus 250, which is 500 rupees at the end of the term, right? So also, yeah, coming to risk factors. So risk is like, as I told, it might be variability in returns. You would have expected that the company will be paying 100 rupees end of this month. But due to various reasons, they might not be able to pay you the complete money and they might pay you some 90 rupees or 95 rupees. Also, there will be chances that they might pay you 105 or 110, depending on the profitability of their business. Now, coming to, there's something called as government bonds or treasury bills. In those cases, the risk will be zero. Today or tomorrow or after 5 years, you will definitely get your money back. That is one guarantee which the government gives for the investors, which is not to be seen in other investments. And hence, we call the government securities as, risk-free assets. So there is also one important term which you need to understand, that is speculation. What do you mean by speculation? For example, recently there was a one stock called Yes Bank which was in news. Correct? The stock price of Yes Bank fell to some 18 rupees or yeah, 17 to 18 rupees. It had come to somewhere around 70 to 18 rupees. So that's when I wanted to invest in this stock because anyhow the share prices have reached rock bottom and the chances of them going beyond 18 rupees was very less. So what I thought was that let me invest some 10,000 rupees the next day. So even if you imagine the stock prices to be some 20 rupees and I invested 10,000 rupees. After 15 days or yeah, I think yeah, roughly 15 to 20 days, the stock prices rose up to 54 rupees or 56 rupees. Let's assume 50 rupees to be precise. So what is the percentage of growth? From 20 to 50, it's like 150% of appreciation, right? So if I had invested 10,000 rupees when the price was 20, I would have earned 25,000 rupees when the share prices would have reached 50 rupees per share. This is what we call it as speculation. It is like a very short term investment in nature, a short term investment, and it's like the risk also will be very high and return will also be very high. Imagine if that 18 rupees went down to 9 rupees and I had invested 10,000 rupees and I would be getting just 5,000 rupees, right? The risk factor will also be very high and the returns will also be very high. That's what we call it as speculation. Usually it's like these gambling or those kind of activities we call it as speculation. Speculators usually concentrate for high risk and high return. Now, let's understand the difference between investment and speculation. First thing, time horizon. Investor will usually invest for a longer period of time. He'll keep in mind say some 5 years, 10 years, 15 years. Whereas speculator, he'll just trade for a few days. Like I said, in the case of Yes Bank, in 15 days, there were chances that one speculator could have earned some, 150% of returns, right? How? Coming to risk perspective, normally investors will have less risk when compared to speculator. Compared to speculator, the investor will always have less risk. whereas speculator will always have high risk on his head. Next, coming to decision, you know, speculator will usually go based on his own vibes, or like I said, I just thought of investing in Yes Bank when it came to 20 rupees. It was just my thought. I did not go to the market. I did not study what actually Yes Bank happened. I mean, what happened to Yes Bank actually, or how their share prices actually moved. Or I did not concentrate on any of those aspects. I just wanted to invest because the stock prices came to the rock bottom. Whereas investor takes his decision based on various judgments or expert opinions, or he would have made his fundamental analysis, or you know, there will be various other technical aspects like technical charts, or you know, there's various blogs who write exclusively on investments, and based on all those judgments, investor takes a decision. Now, coming to leverage, investor usually, sets aside some part of his earnings so that that could be invested in his funds, or that could be employed as investments. Whereas speculator usually tries to borrow money and tries to make his, investment. He just borrows money, and also he uses his personal funds for his speculation activities. Like I said, when I just wanted 10,000 rupees to be invested overnight, obviously I did not have that much of money in my hands too. But I thought of, getting more loans from various sources. So if I had invested, imagine I had taken a loan for 1 lakh rupees and I had invested in that, I would have earned 2,50,000 rupees for in a matter of 15 days, right? So that's how speculator actually thinks. Now, return expectation. Since the risk is very moderate in the for an investor, he obviously will expect lesser returns. Whereas speculator would have taken more risk. He would have, as I said, he would have taken loan of rupees 1 lakh rupees, 2 lakh rupees, and would have invested. And he obviously expects more return for the risk he would have taken. Now, let's understand what is gambling and what is arbitrage. Gambling. Gambling is like just like there'll be these casinos, or uh, this gambling is like uh, playing certain games like cards, or horse races, or lotteries, or playing in casinos, for which people do it for fun and not actually as an investment or as a speculation. It's just that they have this habit of playing all these things based on the rumors or hunches. It is played in an unscientific manner which doesn't have any judgments or basis for their judgments actually, and they just do it for fun. Now, coming to something called as arbitrage. Arbitrage is like making profits due to changes in prices between different markets. So let's take this example. Imagine in a shop A, there's a shop called A. There you are able to, there the shopkeeper is selling 1 kg of rice at 80 rupees. Similarly, there is shop B in the market. In shop B, he is selling the rice at 100 rupees per kg. So arbitrage is like you purchase goods at 80 rupees per kg from shop A and sell it at 100 rupees per kg in shop B, right? So this is how arbitrage work. It's like the same commodity or same stock, you can buy it in one market and sell it in another market, just because of the variation in the stock price, stock, or that yeah, stocks or securities prices. If you want to try this, you can actually google it. Google the stock price of a particular stock or particular company under Bombay Stock Exchange. Also go to National Stock Exchange and check the stock price of the same company. There will be slight difference, but even if it is zero point 0.1 rupee, if you invest 10,000 rupees, if you invest say some 10 lakh rupees, you'll be earning 10% is 1 lakh rupees easily you can earn, right? So that's how arbitrage work. Also have pasted one video in this document after arbitrage. Please do watch that video. It is very informative and will definitely help you. Now, coming to the next topic, let's understand the forms of investments. There are two types of investments. One is financial investment and another is non-financial investment. Under financial investment, there are two types. First is marketable financial assets and second is non-marketable assets. Marketable financial assets are those financial assets which can be traded in the market. For example, I purchase equity shares today. Tomorrow I can sell it. Today I'll purchase preference shares. I can easily sell it. Those type of assets we call it as marketable financial assets. Also there will be certain other cases like I would have kept money in a fixed deposit in my name. That fixed deposit cannot be traded in an open market. Those type of securities we call it as non-marketable assets. Coming to non-financial forms of assets, there are two things. First is real estate. Second is your precious objects. First, let's see the types of marketable financial assets. First is your equity shares. Equity shares are like ownership capital which you would have contributed to the company, right? Preference shares are also capital contributed to a company, but preference shares will always have a preferential right when compared to equity shares. It's like if a company earns dividends, the first it will try to pay its preference shares, then comes your equity shares. Also, if there is any surplus of funds left with the company, it will be uh, the first the surplus will always be given to equity shareholders. The preference shareholders will be given their part of profit. Say, for example, if there is 20% preference shares, 20% of their capital contributed will only be given to them. Rest, whatever is left with the company after paying off preference shareholders will definitely belong to equity shareholders. Also, if you imagine that the company is making losses, equity shareholders can always be denied giving dividends, right? Dividends will not be guaranteed to the equity shareholders. Also, capital might not be paid in case of losses or situations of bankruptcy. The capital might not be paid back to the equity shareholders. Next, debentures. Debentures actually acknowledge debt. For example, it's like if you purchase a debenture of 100 rupees, it means that company X owes you 100 rupees. It is liable to pay you 100 rupees, for which it will be also paying you interest for the amount deposited by you. If you would have invested 100 rupees in debentures of X Limited at 10%, every year it will be paying you 10 rupees till it pays back your 100 rupees of principal. Coming to bonds, bonds are actually very much similar to debentures. It's like acknowledging debt. Bonds are like a written document in which company acknowledges that it is supposed to pay you a certain amount of money and at also an interest rate. Next, coming to financial derivatives. Derivatives is like a financial instrument which derives its value from other underlying assets. For example, uh, onions are always fluctuating. It might go up to 180 rupees per kg. Also it might fall back to some 2 rupees per kg, 1 rupee per kg, like that. If a Pizza Hut or Domino's wants to purchase onions, it might enter into derivatives for the simple fact that it doesn't want to change its selling price of pizzas based on the availability of onions in the market. If onions are available at 2 rupees, pizzas prices will not drop to 10 rupees or 20 rupees. Similarly, if the onion prices shoot up to 180 rupees per kg, the Pizza Hut might not charge you extra money. If it keeps doing that, the trust factor will be gone for Pizza Hut or Domino's. So they might enter into an agreement with the farmer that at a predetermined price, a financial derivative can be drawn wherein on a certain date, a certain commodity of certain quality of certain quantity will be given to the uh, given to a person by the farmer, right? This is what we call it as financial derivative. Coming to non-marketable assets, first is your bank deposits. I've discussed this. It's nothing but your fixed deposits in your banks, which cannot be traded in an open market. Next is money market instruments. Money market instruments are basically like the instruments for short term, maybe for 91 days in case of your treasury bills, or any short term funds drawn. We call it as money market instruments, which are not marketable. Next is your mutual funds. Mutual funds are like you invest some amount of money with a bank or with a financial intermediary, like blue chip, wherein they accumulate all the funds and they categorize their investors, and based on their risk taking capabilities, they'll allocate the funds to different portfolios, and the returns from those portfolios will be given to the investors. This is how mutual funds work. Under these cases also, the mutual funds cannot be traded in an open market. Next is your insurance. Insurance, I hope you guys know what is an insurance. It's like providing guarantee, or like if something goes wrong, the insurance company will be there to uh, pay you for your damages. For example, there are so many players or singers who would have taken insurance for their body parts. Like I recently heard that one of the singer had got her vocal cord, the throat, insured. If something happens to her throat, the company will have to pay her in huge sums. That's about insurance. Even insurance cannot be traded in open markets. Coming to your non-financial forms of investments, these are not like financial forms, but they are tangible. First is your real estate. Under real estate, there are various types. First is your residential house. Residential house invested is like you would have purchased a building for yourself and your family to live in. That we call it as residential house. Second is your commercial property. Commercial property is like you would have bought a complex, right? For which you would have rented it out. People will be paying you rent for them using your property. That's about your commercial property. Next is your agricultural land. Agricultural land is like uh, you know uh, a place a place under the government surveillance. There's something called as green belt, which only farmers can use those land, and in that land only you are supposed to grow crops, and you cannot convert it into sites or plots and sell it. You cannot make it. So coming to the next type, it's precious objects can be gold and silver. The gold prices also keeps on varying. Also, one thing what I have observed is that my personal opinion, uh, I usually find that gold and stock prices are indirectly proportional. If gold prices increases, there'll be a slight dip in stock market. If there is a slight increase in the stock market, the gold prices will decrease a bit. So I feel they're inversely proportional to each other. Coming to precious stones, there are various other antique things or antique objects in our country. Like I heard that. The seat or the chair in which Maharaja sits, or Maharaja of Mysuru sits, is worth some 750 crores. So that's how worth they are. And next is your art objects. Art is like, you can never pay completely to an art. There might be a painting, there might be a person singing. You can just pay the remuneration, but you can never fulfill for the artwork what they do. So you can purchase that and you can even make an investment out of it. So this is about your financial forms of investment, sorry, types of investments.